Sunday morning, you wake up, you grab your coffee, reach for your phone, open your portfolio app, and you just immediately wish you'd stayed in bed.
Oh, yeah.
I think we have to be honest about what we all just witnessed this weekend.
It was a sea of red,
Wow.
just absolute carnage across the board.
Carnage is putting it lightly. We are looking at a historic flush, a true Black Sunday. I was crunching the numbers from the sources this morning, and the damage is just staggering. Bitcoin dropped nearly 6% in 24 hours.
Slicing right through that $80,000 floor.
Exactly. But what really blew my mind, and we really need to dig into, is that it wasn't just crypto. Gold futures plummeted over 11%. And silver futures crashed over 30%.
That silver drop is the statistic that keeps me up at night. I mean, a 30% drawdown in a major commodity in a single session. That isn't normal volatility.
No.
That is a liquidation event that just screams at something fundamental in the market. Plumbing broke.
And that sets the stage perfectly for today's deep dive. The mission is simple. Rethink everything. Because if you are holding gold as a hedge against a Bitcoin crash, well, you got wrecked.
You got wrecked.
If you were holding Bitcoin as a hedge against the fiat system, you also got wrecked. They all just jumped off the cliff holding hands. We have to figure out why.
Why did safe haven assets and risk-on assets correlate perfectly to the downside? Is this just a temporary flush, or is this the start of a deep winter?
It's the trillion-dollar question, and I mean that literally. If you look at the data from Amber Data and the market reports, nearly $1 trillion in value evaporated from crypto alone.
In less than 24 hours.
Just
gone.
So we have the Kraken data, we've got institutional analysis, we've got the tariff news. Let's construct the anatomy of this crash, because looking at the charts, this didn't feel like a slow bleed.
No, it felt like the floor just fell out from under everyone. It was a mechanical failure. We have to separate price from value here. The Bitcoin network didn't halt,
Right, there were no hacks. The network itself is fine.
It was entirely about market structure and leverage.
Right. I mean, Bitcoin was testing that $125,000 high back in October of 25. Now we're scraping the bottom of the barrel in the, $75,000 to $81,000 range?
Yeah, and what stood out to me was the sheer volume of liquidations. The sources are putting it between $1.68 billion and $2.2 billion.
Wiped out in a single day.
And look at the composition of those liquidations. 93% were long positions.
Which tells us the market was just incredibly lopsided. The open interest must have been through the roof.
It was so crowded. Everyone was on the same side of the boat. Traders were leveraged to the gills, expecting that, the January effect would just carry on forever.
They saw the ETF inflows from last year and assumed the bid would always be there?
Exactly. But when you have that much leverage in the system, that much debt backing those positions, you don't need a disaster to crash the price. You just need a whisper.
It's the classic long squeeze. Price ticks down.
Margin calls go out.
Traders can't post collateral. The exchange auto-sells their bag, which drives the price down further. Rinse and repeat.
It's a cascade. But I want to highlight something from the notes that really emphasizes how violent this was. Did you see the data from Hyperliquid?
Oh, the decentralized exchange data. Yeah, that caught my eye. There was a single Ethereum position 1 trade that got liquidated for $223 million.
$223 million. Vaporized.
Wow. That's not a retail trader on Reddit. That is a whale. That's a fund.
Precisely. That signals institutional stress. When you see 9-figure positions getting liquidated on-chain, it means the big players got caught offside.
They were probably using cross-margin, borrowing against their crypto to buy more crypto.
And when the floor broke, the algorithm showed zero mercy. This is the difference between DeFi and traditional finance. There's no broker to call you and ask for a wire transfer by Monday. The code just executes.
Instantly, which explains the speed of the drop. In traditional markets, you might get a limit down halt.
But in crypto, specifically on a Sunday when bank liquidity is offline, you just get a free fall.
Right. Sunday liquidity is notoriously thin in Asia and Europe anyway. It's the perfect time for a raid.
So we have the setup, a market that's over-leveraged and complacent.
But a powder keg doesn't explode without a spark. And this weekend, we didn't just get a spark, we got a flamethrower. We need to talk about the 1-2 punch of macro news.
It was a brutal combination. First, you have the geopolitical shock. President Trump taking to Truth Social to announce a 100% tariff on Chinese exports.
Which the market immediately read as a declaration of a trade war. But let's peel that back a layer. This isn't just about tariffs are bad for business. This is specific to the tech sector, isn't it?
100%. The accusation was that China is restricting exports of vital materials for tech manufacturing. If you slap a 100% tariff on Chinese goods, you are disrupting the supply chain for, well, everything. Semiconductors, mining, hardware.
The entire infrastructure that runs the digital economy.
So the algo traders read tariff, they calculate supply chain disruption, and they just dump tech stocks and crypto simultaneously.
And it sparked panic selling in Asia immediately.
But that was just the jab. The right hook was the Warsh effect.
This is the part I find fascinating. The rumors are solidifying that Kevin Warsh is Trump's pick to replace Jerome Powell at the Fed. Now, for the uninitiated, they might think, who cares? One suit replaces another. But Warsh represents a massive regime change, doesn't he?
He does, and this is why the Rethink Everything theme is so important. For the last year, the whole trade has been currency debasement.
Right. You buy Bitcoin and gold because the Fed is going to cut rates, print money, and let inflation run hot to service the debt.
The dovish pivot everyone bet on. The money printer go burr thesis.
Exactly.
But Kevin Warsh is a hawk. He has a history of favoring higher real interest rates and a stronger dollar. So if the market believes Warsh is coming in, they have to reprice the entire future of the U.S. dollar.
It's the denominator effect. If the dollar gets stronger, if the DXY rips upward, everything priced in dollars has to go down numerically to maintain its value.
Exactly. And it kills the debasement narrative. If Warsh tightens the money supply, cash suddenly becomes a viable asset again. You can get yield on your dollars.
So why hold a volatile rock like gold or a digital asset like Bitcoin?
That explains the correlation. Usually if there's a trade war panic, you buy gold. But if there's a hawkish Fed, which means a strong dollar, you sell gold.
The hawkish Fed news just overpowered the trade war panic.
The Warsh effect sucked the liquidity out of the room. It convinced the market that the era of easy money is ending. And when easy money ends, risk assets are the first to get sold.
This leads us perfectly into the institutional side of things, because we can talk about retail panic, but the real movers in 2025 were the ETFs, BlackRock, Fidelity, the so-called boomer ballers.
And the data shows they are not buying this dip. In fact, they're fleeing.
The flows have completely reversed. We saw over $1.62 billion in outflows from U.S. spot Bitcoin ETFs in just 4 days in late January. That is a massive exodus.
And I don't buy that these institutions suddenly decided Bitcoin is dead. This feels mechanical. I was reading about the basis trade, unwind in the notes.
Yes, this is crucial for people to understand because it explains why the selling is just so relentless.
It's the invisible hand moving the market right now. See, a lot of the money that poured into those ETFs in 2025 wasn't from long-only investors who love Bitcoin.
It was hedge funds.
Those hedge funds putting on an arbitrage trade. They buy the ETF, which is spot, and they sell the futures, which is short, just to capture that spread between them.
It's basically a risk-free yield farming strategy, but using traditional markets.
Correct. And in 2025, that spread was massive. It was paying out something like 17% annualized returns. If you're a hedge fund manager, that's a hero trade. You take it all day.
But markets are efficient. Eventually, that spread has to tighten.
And it did. As we enter 2026, the yield on that trade compressed down to about 4.7%.
4.7. I mean, let's be real. You can get close to that in a short-term T-bill right now without touching a crypto asset.
Exactly. The risk premium just evaporated. Why deal with the volatility, the custody risk, the headline risk of crypto for a 4.7% return when you could just sit in treasuries?
So these mercenary funds, as you call them, are closing the trade.
And to close the trade, what do they have to do? They have to sell their ETF shares.
Which forces BlackRock to sell the underlying Bitcoin. It's a mechanical unwind. It doesn't matter what the sentiment is. The math just says sell.
So you have the leverage flush on the crypto exchanges, and simultaneously you have the basis trade unwind in the EPS. It's a double whammy of supply hitting a market with no demand.
That is the literal definition of a distribution phase. The institutions are handing the bags back to, well, whoever's willing to catch them, which brings us to the charts.
Yeah.
Because if you're a technical trader, you're looking at this falling knife and just wondering, where's the floor?
The technical damage is significant. Bitcoin broke the $85,150 support. That was a key level. It had held twice before.
And when a support breaks on the third test, it usually flips into resistance.
For sure. It also sliced right through the 50-day and the 200-session moving averages.
That 200-session average is usually the line between a bull market and a bear market. Being below that is Not great.
It is bearish territory. The analysts in our sources are all drawing a line in the sand at the April 2025 low. That's around $74,500 to $75,000.
And we are dangerously close to that right now.
If $75,000 gives way, there's very little structural support until you get to about $69,300. And if that breaks, well, you're looking at a revisit of the $50,000 region.
That would be a complete reset of the last 18 months of gains.
But, and here's where it gets really interesting, there's a massive contradiction in the data. While the price is collapsing and institutions are fleeing.
The on-chain activity is exploding.
Yes, this is the divergence that every contrarian is looking at. On-chain data shows the highest daily increase in new Bitcoin addresses in 2 months.
So while the whales are getting liquidated and the hedge funds are unwinding their trades, someone is opening wallets and buying.
It looks like aggressive bottom fishing. It suggests that while the paper market, futures and ETFs is selling off, the physical market of people who actually want to hold the asset is stepping in.
It's the transfer of wealth from the leverage to the patient.
And the network fundamentals back that up. Hash rates are at all-time highs. The miners aren't capitulating yet. The network is secure. This is purely a financial structure crisis, not a technological one.
That's a key takeaway. But I want to circle back to the silver anomaly. Because we keep saying Bitcoin dropped, gold dropped, but silver dropping 30%, that feels like the canary in the coal mine for the broader economy.
It absolutely is. You don't see a 30% drop in a hard asset unless funds are desperate for liquidity. This is what we call selling the winners.
Right. When you have a margin call on a bad position, you don't sell the asset that's down, you sell the asset that has liquidity.
So they were dumping silver just to raise cash to cover losses elsewhere. That's the most likely scenario. It signals a total liquidation event.
It means cash is the only thing that matters right now.
And it completely destroys the safe haven myth.
We really do have to rethink that term, safe haven.
In a true liquidity crisis, there are no safe havens except the US dollar. Everything else, gold, silver, Bitcoin, is just an asset that can be sold. And this weekend, they were all sold.
Even the corporate proxies. Look at MicroStrategy, down 10%.
MicroStrategy is essentially a leveraged Bitcoin ETF at this point. Investors treat it as a high beta play. When Bitcoin moves 1%, MicroStrategy moves 2%. So when Bitcoin crashes, MicroStrategy gets hammered.
So it's not a safety play, it's an amplification play.
Precisely.
So where does this leave us? We're sitting in the wreckage. The narrative of 2025 is dead. The easy money basis trade is dead. The safe haven idea is bruised, if not broken. What happens next?
We wait for the macro picture to resolve. Does Trump actually implement the 100% tariff, or is it just a negotiation tactic? Does Warch get the Fed seat, or is it a head fake?
Until we know the rules of the game, volatility is going to remain extreme.
Exactly.
But I want to end on a bit of game theory, because there is a wild card here that we haven't seen in previous cycles.
The sovereign reserve concept.
The strategic Bitcoin reserve. We know the U.S. government has been discussing it. We know states like Texas are building their own reserves. If you are a sovereign entity and you have a mandate to acquire Bitcoin, do you buy it at $125,000?
Or do you wait for a crash like this? That is the fascinating twist. If you are the U.S. Treasury or a sovereign wealth fund, this crash is actually your best case scenario. You want to acquire assets without spiking the price.
A liquidity flush gives you the cover to enter the market.
So could we see a situation where the Warsh effect drives the price down, but the strategic reserve bid puts a floor under it?
It creates a government put. In the stock market, we used to talk about the Fed put, the idea that the Fed would step in to save the market.
Now, we might be looking at a treasury put on Bitcoin. If the price drops to $75,000 and the U.S. government starts buying, that is a floor that cannot easily be broken.
But that puts the government at odds with itself. You have the Fed trying to tighten conditions and the Treasury potentially trying to shore up a reserve asset.
Welcome to 2026. The monetary policy signals are crossed. And that is why this is so dangerous for the average investor. You are caught between these massive tectonic plates: the Fed, the Treasury, the hedge funds, and geopolitics.
It sounds like the advice for you listening is, don't try to be a hero.
Watch the $75,000 level. If it holds, we might see a base form. If it breaks, don't try to catch the falling knife. And for heaven's sake, understand that leverage is what killed the market this weekend.
Right.
If you are simply holding spot, you still own the same amount of Bitcoin you owned on Friday. If you are leveraged, you own nothing.
Cash is a position. Patience is a strategy.
And sometimes doing nothing is the hardest trade of all.
We're going to be tracking that 75K line like a hawk all week. Thanks for diving in with us. Keep your head on a swivel out there.
Stay safe.